I've been talking to you guys about recession indicators, and the indicators are warning recession is coming. Where the recession hits, the stock market will peak. Cuts are associated with the coming recession. Powell and the Fed are now in denial about it and believing their own propaganda about a soft landing, which is fairy tales. Soon they'll have to admit that when they start doing emergency rate cuts, which they have done the last two bear markets that have been associated with recession. We were blindsided by the recession, but I've been showing you different recession indicators. This is one of them. This is industrial production, and it's warning right now. Not every sign of weakness is a signal that leads to recession, but before the recessions occur, you often will see the industrial production start weakening, often will diverge with the market before the recession shows up. That's exactly what we have right now. It's not making new highs. It's making a series of lower highs. It's diverging as we had in 2020, just as we had back in 2001 over here. Gray shaded areas are recession. And again, we're likely about to enter recession. What happens is it stops making new highs and often will diverge with the stock market, but other times it'll just start turning down right when the recession begins, like what we had over here in 2007. But I think we have something very similar to what we had in 2020 and also in 2001. But it's already stopped making new highs. It's already diverging as it's done in the past. I'll be looking for a significant decline in industrial production. We move right before a recession or as we move into recession, one or the other. You likely get this, usually get this right before the recession shows up, and then you start seeing industrial production sharply decline as we move into recession. It sharply declines. And again, now I think there was a lot of concern back over here for an economic slowdown, concerns that the stock market would begin to fall apart after QE3. We had 3 rounds of QE. QE3 was in 2012. Began to reduce the Fed began to reduce the pace of their asset purchases. It's called tapering, and it's what happened is ended towards the end of 2013. They began to taper, and then by the end of 2014, here, QE3 ended, led to a downturn in 2015 and 16. Towards the end of 2015 and then early 2016, we saw about a 17% sell-off in the market and see some weakness. We had the election, and what happened back then? Trump won the election. Great excitement about the tax cuts and deregulation, and that new economic policy was going to make the economy boom, and that acted as its own stimulus. The thinking is we're going to see that now. And as I said, economic policy will take time to implement. It's too late because the recession indicators have already been flashed. They've already flashed, I should say. We're going to have the recession. Continue to point out there was buzz about tax policy and the tax cuts in 2001, with the 2000 election. Eventually, through in 2001, it was a buy the rumor, sell the news event, and the stock market bounced on it. And then when the tax cuts passed, the market collapsed right after. See something very, very similar to that. And again, the problem is we've already had warning signs that recession is about to happen. Industrial production, again, making lower highs, forming a divergence. It's done at other times with the stock market. It's not making new highs, but yet the stock market is. I think is another huge red flag. But like I said, we'll likely see right before the recession starts or right as the recession starts a significant decline in industrial production. Had December 13th, the uninverting of the yield curve between the 10-year and the 3-month. Again, when this has happened in the past, we were months away from a recession. 2007, the recession showed up 2 months later. In 2001, the recession showed up 5.5, 6 months later. The recession showed up. In both cases, the stock market peaked and sharply sold off. Inverting of the yield curve is telling you recession is getting very, very close with the uninverting of the 10-month and the spread between the 10-month and the 3-month yield. When it's negative, it means short-term rates are higher than long-term rates. When it uninverts, as we've seen, this is the inverting of the yield curve. The uninverting of the yield curve means that 10-year is back above the 3, but it's steepening, and this is what happens before the recession. I still think we're going up to this trend line right here, and then I think we're going to see a top, as I've talked about at great length and detail, but just want to continue to point that out. When your recession's right about to happen, but experts, oh, it's wonderful, rates are normalizing, this is a great thing, the Fed, oh, great, avoided a recession. Dismiss this stuff. This is predicted correctly the last 10 recessions or so. Now we're getting the yield curve between the 2-year and the 10-year already uninverted September 6th, but like I said, the 10 and the 3-month, that happens right before the recession happens. Well, now we're seeing the steepening of the yield curve, the spread between the two, going higher. This is telling us a recession is getting even closer. That's what it's telling you. Now again, let me say this. Sometimes, right before the recession happens, it will go briefly back and we'll see the inverting of the yield curve briefly right before the recession starts. That happens sometimes. Not always, but sometimes. Something worth watching. But again, this rising is telling you that the recession is getting closer. We're getting all these warning signs of recession. Watch the video all the way through. You'll see what I mean. We're getting closer to the recession, coming up and hitting these major trend lines in the monthly time frame. And again, overthrowing it a little bit here on NASDAQ. The Dow did that. Seeing that on the S&P a little bit. We saw that in 1929. Throwing the trend line, having an overthrow to it, but then turning right back down. The Dow has probably peaked. Now the Dow had an overthrow of this trend line, now reversing hard. We've seen a sell-off with the Dow. We've seen a sell-off with the Russell. The NASDAQ rose to new high. The Russell peaked in late November. The Dow peaked on December 4th. So far. But again, I think we're getting an overthrow, much like what we had in 1929. We overthrew the upper boundary trend line here. We got a good chance. The Dow has peaked. Recover into January, I think it could get a lower high on the Dow. It goes up. It's the upper boundary on the weekly chart, but we turned off the weekly chart and just overthrowing this trend line, and that's what I think is going to happen with the S&P. I think the S&P is going to overthrow. We've already hit my target. Back on Black Friday, the very last day of November, we hit the target on the S&P in the monthly time frame, but we haven't reached my target yet in the weekly time frame. I think we will, and I think we'll have the same scenario on the S&P that we have with the Dow. I think we'll overthrow here, and we already are overthrowing. We did with our recent high, overthrow the upper trend line, reach that weekly trend line, and then I think you'll reverse hard off of it as the Dow did. Monthly trend line. Dow had that big drop again. While NASDAQ was still moving higher, peaking on December 4th. We dropped 6.6%. We're trying to bounce off the 100-period moving average at this time. If we end up setting up a lower high, S&P could still make a higher high. We might reach a new high. If we do, we'll just slam into the trend line again in all likelihood. But I think the Dow has likely peaked, and we'll probably see a lower high set up. Even if it doesn't, even if I'm wrong about that, again, you have that upper channel line in the weekly time frame, which I've talked about at great length and detail on the Dow. We turned right off of that parallel boundary in the weekly time frame. We overthrew the trend line on the monthly chart. Again, if the Dow goes to a new high, we'll just go back up and hit this trend line again and go slightly higher. But again, it could be the Dow has peaked. But again, the Dow's testing our 20-week moving average. Could see a bounce off of the Dow. Still may get another reference point of a divergence and go back up in January if we reach this level or confirm a lower high, one or the other. But I think that the Dow is in a topping process, and I think you got a shot, no guarantee, but a shot that it has peaked. My guess is it has. But again, if I'm wrong about that, then we just go back up to the trend line again and go slightly higher than the previous peak. And again, you've got that MACD and price oscillator rolling over. Maybe we get a divergence or confirmation of a lower high in the more recent price action. And again, I think a January rally, S&P to reach my target is likely. I think the Dow will get a counter trend, maybe a new high. But the Dow has had a bigger sell-off than the S&P. So It peaks before the S&P. Before the S&P peaked in 2000, the Dow peaked just before the S&P did. Sometimes it plays out that way. As we're getting all these warning signs of recession, we're coming up and we're slamming into this trend line 4 weeks ago today, on the last day of November, the last trading day of the month of November. On Black Friday, we slammed up into that trend line, the black trend line there, including the shadow from the 2000 high. The red trend line excluded it. I talked about reaching this in that mid 6,000 area. We did at the 6,040 to 6,050 area. We hit 6,044, slammed into it, moved into the new month, but then we went higher. I told you we are going to overthrow this level. Why? Because we haven't reached the trend line in the weekly time frame. I still believe that we're going to do that. The Dow overthrew the monthly trend line and hit the upper channel line in the weekly time frame. I think the S&P will do the same thing. The Dow turned sharply down off of that trend line in the weekly time frame. That's why I think you got a pretty good shot that the Dow has peaked, well, at least for now, but my guess is it's peaked. If not, we go up and hit the trend line in the weekly time frame one more time in January. We've hit the trend line here. If I just bring up the weekly chart here, you can see we haven't reached the upper channel line. Now again, the trend line is the target. Talked about moving into the 61, high 6100 area, overthrowing the trend line in the monthly time frame. Tried to reach it in December. We have not reached it in December. Let me just go back to my train of thought here when I was talking about the trend line being the target. The trend line, we haven't reached it in 8 weeks. If we go on into January, as it looks like we're now going to go into January, before reaching that level, the further right you go to the chart, the higher the trend line goes. That's coming in the 6,200 to 6,300 range now. Was at the 6,000, the high 6,000 previously. The 6,100 area that I've talked about so much, still didn't reach it. We fell short. We came up and we hit 6,099 and we turned down. We were just shy of reaching that trend line 4 weeks ago. Still think we're likely going to reach it. That will take the S&P probably into 6,200 or on into 6,300. That range somewhere in there. The trend line's the target, not some number. Keep that in mind. Still believe the S&P will make new all-time highs. Still think the bulls are in control and that we will go higher. That's where I think we're going to reach. It will likely take us into 6,200, maybe into 6,300 by the time we reach that level. That could be in the next few weeks. Very possibly a peak in January. Could see a big rally back up. Looking for a 2050 sell signal, a drop below the 20-week moving average. The Dow is trying to bounce off of it right now. S&P hasn't reached it, but once we get a top, watch for a drop below the 20-week moving average, and for the RSI to drop below 50. That's a 2050 sell signal. Notice back over here, we bounced off the 50, got back above the 20, and when we got back above the 20-week moving average here, we jumped back above 50, and we've been above 50. So you've been above 50 here, you've been above the 20 here. We had a breach of it here, but a hollow red candlestick got back above it. After a dip below it, and it's acted as support over and over again after getting above it here, here, and just above it right here. And right now we're just above it as well. So I still think we're going to reach this level. I still think we're going to new all-time highs. The MACD will probably do something like what it did over here, where it turned down and then it turned back up, and you're getting this topping process very, very similar to what I think happened at the 2022 top with reference to the MACD. Again, I've talked about S&P reaching this upper channel line here in the weekly time frame. If it does that here in January, and again, I was looking for a top in December, January, guesses we're still going to make new all-time highs, although we have seen a peak in December. Possibly could be it. Guesses it's not. I have the guts to tell you exactly what I think. I think we're still going to reach this trend line. Start seeing the divergences play out, and all the weekly signals began to turn bearish. I think, and falling below the 20-week moving averages, I think you still have a very good shot you're going to reach this level. If we do, something very interesting with the sequence counts. Have the S&P weekly. Let me show you something. Now, something that I watch all the time. It's an interesting count, so I thought I would share it with you. I normally don't share the 2-week bars with you on the S&P 500. This is what you get, one bar every 2 weeks. Shared with you many times the weekly bars. I've shared with you the monthly chart. Found this very interesting. 2 weeks seems to be a little bit more accurate than the monthly chart. I've been watching it for a very, very long time, but I've been watching this count, and it's now almost coming to a conclusion here. And again, a possible double sequence count reversal signal. The previous 2-week bar, we got a 13 count, and we've got a 9 count forming with it that could form a double sequence count reversal signal as we go into January, right past the holidays. Bar 8 of 9, our current 2-week bar that just now finished this Christmas week, finished that 2-week bar. We're now about to start another 2-week bar that will give us a 9 count that I believe will take the S&P to a new high. Now that 2-week bar, the first week of it will be the New Year's Day week. The second week will be the week after, when everybody's coming back from the holidays. Complete the 2-week bar. Start on December 30th, this coming Monday, and it will end on January 10th, the 2-week bar, to complete that 9 count. So in 2 weeks, we could see a new high. The 8 or 9 bar has to be the high of the count for it to be a perfected signal, and it could complete a 13 fall by 9. You may get the 9 bar on the 10th completing and still go a little higher. We have the CPI coming in 3 sessions later with the very next 2-week bar. CPI coming in on January 15th. Could be concerns, a freak out about inflation coming in January. With the Fed, with the bond market, the herd, again, everybody thinks we're going to get, cut. The Fed saying, 2 cuts maybe, 2025. People saying no cuts, are going to have to raise rates. And again, freak out over inflation in all likelihood. And then the recession's going to show up. The stock market will drop. The Fed will do emergency cuts. They're going to cut even though inflation is rising back up. Exactly what happened in 2007 to 2008. At the emergency cut. Inflation was still rising sharply, and it was higher then than it is now. I'm keeping my eye on these 2-week bars because you got bar 8 now completing. We're going to get bar 9 over the next 2 weeks, the lighter trading volume. And again, as we're slamming up into these major trend lines on the weekly chart, and we've already hit the one in the monthly time frame. Picking up what I'm throwing down. The NASDAQ 100 on its 2-week bar is on the same bar, bar 8, but we also have a potential 13. It has not completed a 13. So in the next 2 weeks, first week being the week of New Year's, short abbreviated week, and the abbreviated trading session on New Year's Eve, we're going to get, for the next 2 weeks, we're going to get either the 9 count developing or the 13. They're both the same bar. The 13 will override the 9. Major counts forming in the 2-week time frame. Why is that important? I have found that the 2-week bars seem to be more accurate than the monthly bars. So monthly bars we already got. We're overthrowing, and sometimes you have that happen. But these counts are very, very interesting. Going back to the S&P. The S&P is about to set up a possible 13 followed by a 9. With the next 2-week bar that we get. We'll reach that upper boundary on the weekly chart. 2-week bars, 13.9. Keep that in your head for a minute. 13.9, hitting a major trend line of resistance in the monthly time frame, slightly overthrowing it. But look at the 1929 top. Look at this. It was a 13.9 with the 2-week bars. Now, the 9 bar was a reversal bar. I still think we're going to go up and hit that upper boundary channel line in the weekly time frame, all likelihood. But we have those negative divergences. I think we'll produce a top in either December or January. If we can't rally to a new high, then maybe we have it in December. This is we're still going to try to do that. But you got a 13.9 here in the 2-week time frame at the 1929 top. By the way, it was a 9 count with the 2-week bar that marked the bottom. It wasn't a perfected signal, though. The 7 bar was the bottom of the count, and it was slightly above that, so it was never a perfected signal. But it was a 9 count here in 1932 Isn't that interesting? Again, a similar count to what we have right now as we're going into a major trend line. And this was the peak, the trend line that started the channel that we connect with the 2000 top there in the monthly time frame. But a 13 followed by a 9. And again, then we saw the bottom fall out of the stock market. Now, the S&P did not begin until 1957, but we know what would have happened had it existed on history. That's what this chart does. Other interesting counts in history, we had in 1961 the bear market of 61 to 62. It was a 13 count in the 2-week time frame that marked that. It was a 9 count just before the 66 crash. We got a 9 count, went a little bit higher. The 1987 crash was a 9 count with the 2-week bars. It was now perfected. Bar 7 was the high of the count, but it did complete the count, just not a perfected signal. The 8 or 9 bar has to be the high of the count. There was no perfected signal, no completed signal, I should say, with the 2000 top because there was so much choppiness in the sideways topping process. Had distribution leading up into the peak at the March 2000 top and then a lower high after the distribution there, which led to nearly a 20% crash. Pardon me, 20% crash. A bounce. We had the Fed emergency cuts. Then we sold off right after that. Bounce with it. And then we had the rally hopes of the tax cuts. The tax cuts happened and we sold off even more. It was sell the news event. Then we just had the 13 count on the S&P 500. And again, it could be followed by a 9 count. We had that 13.9 at the 1929 top. We had a 13 at the 2007 top. We had a 13. We had a 13 and we went just a little bit higher. And then we had a 58% crash. We had the 13 count show up at the bottom, a little bit lower, got a bottoming tail, a hammer, and then we bottomed out. And that was it. But a 13 marked the top, a 13 marked the bottom. Kind of interesting. We're getting a 13 right now, and again, possibly a 9 count completing over the next 2 weeks. These are 2-week bars. Again, we had a lot of choppiness towards the top right here. So again, we did not complete the 9 count. They have to be consecutive bars, but the 13 count did end up completing. It can stop and start. There can be interruptions. There can be no interruptions with the 9 count. So back to our current price action here, again, in the 2-week time frame, I'm just saying, look, 13.9 associated with the 1929 top. You had a 13 count associated with the 2007 top and with the 2009 bottom for that bear market. Saying, as we're slamming up into the major trend line of resistance in the monthly time frame, again, this count is forming. Like I said, the reason why I'm showing you the 2-week bars is I watch the 2-week bars. I look at a lot of indicators I never even show you. Something I've been watching for quite a while and close to completing it, and we're slamming up into that level, so I wanted to mention that to you. Get a 9 count over the next 2 weeks, go into January on NASDAQ and the S&P in the 2-week time frame. Kind of interesting that, again, it was a 13.9 that completed the 1929 top. It was a 13 completed the 2007 top. Other peaks along the way, the 60s and the 70s that ushered in bear markets. There are other ones in the 2-week time frame. I'm just showing you some. So the next 2 weeks will be interesting if we complete this 9 count. Again, the 8 bar is not the high of the count. Could the 9 bar be the high of the count and perfect the signal and be a double sequence count reversal signal like we got in 1929, a 13 followed by a 9. And again, chance if we go higher, that plays out as a reversal in the 2-week time frame as we have all those negative divergences hovering over the weekly charts that I've talked about. I do want to point out we already got a 13.9 on the monthly chart. That could mark a turn, but we never did reach the objective target levels on the monthly or the weekly at that time. And I told you we were likely going to reach those levels, and I told you we could go higher, and oftentimes you'll get a 13.9, go a little bit higher. But with the other 13.9 in the 2-week, mark a turn as we overthrow the monthly 13.9 here. interesting. It was a 9.9 that marked the reversal in 2022. Got the peak in 2021 right there, and the very next bar marked the very next 2-week bar, or I'm sorry, very next monthly bar marked the peak there in January. Or pardon me, bar right here actually is the first week of January where we peaked. Just went slightly higher than that other bar just by a fraction. Other 9 counts and 13s have marked tops and bottoms. Here's 2007. Again, we got the 9 count. Here we ended up going a little bit higher, turned down sharply by, I think it was 12 or 14%, and then went back up and went slightly higher than the previous peak. But again, it was associated with the top, so was this 9 count in the monthly time frame. I look at the monthly chart, I look at the 2-week chart, the weekly count on the S&P weekly got canceled out. So I'm watching that 2-week count, and the monthly chart had already completed a 13.9. Did the same thing in 1929. You got a 9 count. You ended up going a little bit higher in the monthly time frame, which is what we're doing right now. But we're slamming up into that monthly trend line that I've talked about, which I told you I thought we'd overthrow like the Dow did. You got a 9 count here. Ended up going a little bit lower, then getting the turn in the bottom. But again, these 9 counts, 13 counts in the monthly and the weekly time frame. But we're doing right now, again, exactly what we did in the monthly time frame in 1929, getting a 9 count going higher, and in the 2-week time frame, getting a 13 and possibly a 9 as we go into the next 2 weeks of trading. Very interesting. Getting that 13.9 on the 2-week bars, we're getting all these recession indicators flashing. You know, I've been talking to you about recession signals, warning we're about to move into a recession. Fed dismisses the recession signals. I actually happen to believe them because they have a proven track record of being correct for decades. Like the uninverting of the yield curve, that's marked recession after recession, predicting it correctly over and over again. At least the last 10 recessions that we've had correctly forecasted by the uninverting of the yield curve. Talked about that. Now, in yesterday's update, I talked to you about this. I just briefly want to mention it again. Never seen this happen in history where you've got the Fed started their rate cutting campaign, and this is the Fed funds rate. It's going down, and this is the 10-year yield. It's going up, and we've now seen 100 basis points of cuts out of the Fed. We've saw 0.5% initially, and then we've seen two quarter point cuts. So we've seen a 1% decline, or 100 basis points decline Fed funds rate, but yet since then we've seen the 10-year yield begin to climb. And again, I think that this is causing the Fed to second guess themselves along with the election. Fed's all concerned about inflation because they're cutting, but yet the bond market, the 10-year yield is going higher. Now these are the long-term rates are set in the marketplace. The short-term rates are set with the Fed funds rate. I think that this is causing the Fed, and why is this going higher? I've talked about it. I told you inflation's going to tick back up. The Fed is still going to cut rates no matter what because we're about to have a recession. But the bond market is predicting in hotter inflation going forward. We're now seeing that show up in the PPI inflation data, which is the wholesale inflation. We got a hot report, could eventually spill over into the CPI. This is telling us what the bond market is thinking, and the bond market is thinking, hey, we're going to see inflation rear its ugly head again. That's what the bond market is saying. That's what this is telling you. We've seen the 10-year yield go up by 100 basis points while we've seen the Fed cut by 100 basis points. That's never happened in history. It's probably got the Fed. That's probably one reason why Jay Powell is scratching his head, now second guessing himself. Oh, we're in no rush to cut, no hurry to cut here. We're in a good place, and declaring victory. We've dodged a recession at the last FOMC meeting. We did. Oh, we're concerned about inflation. And again, the bond market, the traders are concerned about inflation. I am telling you, inflation is going to go higher. It did in 2007, but that still didn't stop the Fed from cutting rates and doing an emergency meeting, slashing rates, which they should be doing right now because we're about to move into recession. But the bond market is going, well, I think inflation is going to go higher. And then President Trump won the election. The bond market thinks that the tax cuts, doing the tax cuts and some of these other new tax cuts that Trump's talking about, and also the tariffs, it's all going to be inflationary, and we're going to just, so they're focused on inflation. Now the Fed's second guessing themselves. Now the Fed is totally hawkish when they should be dovish, focused on inflation. Absolutely incredible. Exactly what they did in 2007. The same monetary policy mistakes. So I just want to get clear. I think we're going to see an inflation freak out very, very soon by the bond market, by the Fed. I think we're already seeing that, but I think we're going to see it big time. As I keep saying, the inflation reports are going to start going higher. We've already now seen it. I've been warning you it's coming. We've now seen it with the PPI wholesale inflation. We're going to get on January 15th, we're going to get, it's just 2.5 weeks away, and then a few days later is the inauguration day. And again, you're going to eventually see this inflation data tick back up, and it very well could be with the next report, because we did see it tick back up sharply with the wholesale inflation. I think the CPI on January 15th, 2.5 weeks from right now, again to see the inflation report start to tick up, and I do believe it's going to go higher. But it's no reason to focus on inflation because the recession is going to take care of the inflation. The Fed should be focusing on the recession. Same exact mistake they made in 2007. Just like they made the mistake of telling us in 2021, inflation went from 4% to 7% by the end of the year, getting elevated above, at 4%, and then it moved to 7%. And they kept telling us it was transitory. Should have been hawkish then, but they were dovish. Now they're hawkish when they should be dovish, doing the complete opposite of what they should be doing. Absolutely incredible. This is telling us right now, and because the Fed has already started cutting and now second guessing themselves, now they're extremely hawkish. I mean, if you watched the last press conference, that was a hawkish cut we got out of the Fed. It is extremely hawkish right now. I'm telling you, when the recession hits, when we start seeing the stock market go down by about 20%, the Fed is going to panic, just like they always do. They did in 2001. They did in 2007. They're going to panic, and they're going to do an emergency cut of either 0.5% or 0.75%. Market will bottom that day, and it'll rally back up big time and get a lower high, and then the bottom is going to fall out of the stock market. We complete the top, which again could be December, January. Now, again, I told you, I have the guts to tell you exactly what I think. I still think we're going to new highs, and that probably means we're going to make a new high in January. But could it be? Think this through. Put on your thinking cap for a moment. Think this through with me. The inflation starts ticking back up, as I believe it will, and we're already seeing with the PPI data. The market will move into freakout mode. The bond market, the herd, Fed is already there. And then we get the inauguration day of President Trump, which could be a sell the news event. We've seen the Trump pump, as it's being called, social media, with the rally that we had off of support, the 50-period moving average, S&P 500. Narrative is, we're going to see this boom in the economy. The president is calling it, we're going to see the golden age. We're going to see the golden age. So the whole narrative on social media is we're going to see this big move, and the economy is just going to start overheating, and it's just going to be so powerful of a move, and the stock market's just starting the bull market. So currency is going to go to the moon. Yet the recession indicators are flashing everywhere. Now, again, could the inauguration day be the news event because of concerns on inflation, because of what's going on in the bond market? Just something worth thinking through. I think that is likely going to be the case. I think the freak out of the market initially could be on inflation, but the recession begins to manifest itself. the Fed moves into total freak out mode and they begin to panic and we get the emergency cut. That's what's happened before. The last two bear markets that we've had,